So, have you heard of the Backdoor Roth IRA? It's not a new type of IRA or anything like that, but rather just an informal name for getting a regular IRA converted to a Roth. Why the need for this? Well, because when you make too much to contribute to a Roth directly, or as one could say, through the front door, you will need this backdoor approach instead. It's really just a money management trick, and the IRS doesn't even have any official guidance on it. But the Roth IRA is such a desirable retirement investment tool that even those who make too much want to get in on it. In this video, I'll tell you everything you need to know about this approach, and if you're a high earner, you can then decide if this is something you want to try. Hey, if you're new to the channel, my name is Elliot. I'm a long-time investor and financial advisor. I create helpful videos just like this one to make you smarter about your money, so be sure to like and hit the subscribe button to stay on top of all the new releases. And now, let's get back to the video. So before I describe the Backdoor Roth IRA, let's take a moment to review what exactly a traditional and Roth IRA are all about. An IRA is short for Individual Retirement Account, and is just a tax advantage account that you can contribute to and invest with for your retirement. For 2025, you can contribute up to $7,000 annually or $8,000 if you are over the age of 50, and then you can access your money starting at age 59 and a half. With traditional IRAs, you do pre-tax contributions, which of course lowers your immediate tax liability, and you can deduct that amount you contribute every year. You can invest the money in your IRA in almost any way you wish, and it'll grow tax deferred. When you withdraw this money in retirement, it does however gets taxed as ordinary income, and you will need to take distributions by age 73. Generally, a traditional IRA is the way to go if you believe you will be in a lower tax bracket upon retirement. Now, a Roth IRA is similar in contribution limits, but that is where the main similarities end. How it gets taxed is significantly different because with a Roth, you pay taxes up front at the time you contribute to it. Because of this, you no longer get an immediate tax deduction, but your money grows and can be withdrawn completely tax-free. The Roth IRA does require that you have it open for at least 5 years before touching the money, even if you are over 59 and a half. But on the plus side, there are no required minimum distributions. So if you don't need it, you can keep the Roth forever and even pass it on to your spouse or kids. It's a great choice if you think your income bracket will be higher in retirement, as you are getting the taxes out of the way up front. So that was a quick overview of the traditional and Roth IRAs. As you can probably tell from the description, there are certain advantages to a Roth, and many consider it to be a superior financial tool as compared to the regular IRA. One dead giveaway that the Roth is very advantageous is the fact that the IRS puts limits who exactly can contribute. The rationale is that this is meant to be a retirement tool for regular folks and not as a tax shelter for the wealthier ones. For that reason, direct Roth contributions phase out after your modified adjusted gross income, or MAGI, hits $165,000 as a single filer or $246,000 as married filing jointly. If your income is above that, you can't contribute to a Roth directly, and the Backdoor Roth IRA becomes a possible option. Okay, so what is it all about? Well, in plain English, you contribute post-tax dollars to a regular IRA and then roll it over into a Roth. Why are you allowed to even do this at all? Good question. And it all stems from an IRS law that states that rollovers from one IRA to another don't have specific limits. Neither does the traditional IRA. Because it is less tax favorable, anyone regardless of income can contribute to one. Thus, financial advisors put two and two together, and voila, you have the backdoor approach. So that is all it is, a way of moving money into a Roth IRA. But again, keep in mind, this needs to be accomplished by making non-deductible contributions, in other words, contributions on which you do not take a tax deduction, to a traditional IRA, and then converting those funds into a Roth IRA. The process for this is fairly straightforward. You first set up a traditional IRA and fund it with after-tax contributions. Then, before you invest anything, you set up a Roth IRA and initiate a conversion by following instructions from the IRA's administrator. If you started with a new IRA and did not invest, but simply funded it with those after-tax contributions, then you shouldn't have any issues, and that is the end of the process. However, like many transactions, the devil is in the details, so let's hit some additional highlights of the process. Probably the main thing you need to know is that this backdoor Roth process does get more complex and convoluted from a taxation perspective if you already have several traditional IRAs to which you contributed to and invested with. In this case, you must first figure out what kind of contributions are in your accounts. There could be two types: deductible contributions and any earnings, and non-deductible contributions. The non-deductible contributions are tracked separately with IRS Form 8606, and it might be a good idea to check with your tax professional to make sure it's filed. Why is this all important? Well, as you may have already guessed, in a conversion, deductible contributions and any earnings will generally be taxable, while non-deductible contributions generally won't be. However, here's the problem. You don't get to cherry pick and only choose to convert your non-deductible contributions. Instead, the tax liability on a conversion will be based on the ratio of deductible contributions and earnings to non-deductible contributions across all your IRA accounts. taxes. That's because the IRS uses something called IRA aggregation or pro-rata rule when calculating taxes owed on a conversion, which means it views all your traditional IRAs as a single tax entity. If you have 5 different traditional IRAs, the IRS considers them as one entity that you are converting from. So for example, suppose you have combined traditional IRAs worth $50,000, which are composed of 10% in non-deductible contributions and 90% in deductible contributions. If you want to convert $5,000 to a Roth IRA, then 90% of the money you decide to convert would be taxable. You'd pay taxes on $4,500 or 90% out of the $5,000. What I just described underscores the biggest issue you need to watch out for. Some or most of a backdoor Roth conversion could be a taxable event. You may have to pay federal, state, and local taxes on converted earnings and deductible contributions. Also, conversions could kick you into a higher tax bracket for the year, so you may want to carefully watch how much you convert per year in order to avoid that. This can all get a bit confusing, so it's a very good idea to first talk with your accountant or tax advisor before doing any backdoor conversions. It's a lot to consider, especially if it's the first time you have done this. But having said that, the backdoor conversion will open up a really good financial tool for you that you may otherwise have been shut out of due to your higher adjusted income. Okay, hope you learned something new, and if you did, drop a like and be sure to subscribe to the channel. And I will see you all in the next video.